And now return to our discussion with Bill Nygren, who's partner and portfolio manager of the Oakmark Select Fund at Harris Associates. He's been quite a success at his technique at concentrated investing. Thanks for waiting with us through those comments from Senator Dodd. So yes, such a success, Bill, that your Oakmark Select Fund is beating 93% of its peers this year. In 2008, you were only beating 62% of your peers. So tell me how you managed to improve your returns.
Well, I think there are a couple of things that we did right at Oakmark this year that were traps that caught other investors. One was in the chaos of both last November and March. Some good investors abandoned their discipline. Stocks looked cheap by almost any measure that you could value them on, and we stuck with the stocks that we owned. We wanted to stay invested in the asset category, and that was a big thing. And obviously, unfortunately, a mistake that many mutual fund investors made because they were redeeming. I think the second thing we did is we weren't frozen. We believed the economy was going to recover. It was a question of when, not if. And there are some tremendous opportunities for swaps as the names that were the safer names didn't fall much, just as many other stocks were falling, getting cut in half, if not more. We were able to make some of those changes in the portfolio, and those have helped our returns quite a bit this year.
All right, Bill, we're going to take a commercial break and return to talk about some of your picks, some of your funds holdings after this. Back with Bill Nygren, partner, fund manager, Harris Associates. He runs the Oakmark Select Fund, which is beating 93% of its peers year to date. And the key with this is it's a consolidated, concentrated investment fund, which means that, Bill, you only pick stocks out of a certain number of industries. So tell me, with that strategy in mind, what is your favorite industry right now?
Well, we really think more at the stock level than at the industry level, but trying to talk more big picture, as a long-term value investor, we tend to like what's out of favor because those are the opportunities to buy at really cheap prices. And I think right now, most anything healthcare related is quite out of favor because of the uncertainties about what's going to happen on the legislative front. So we've got holdings in Shearing Plow, which is getting acquired by Merck. We think Merck is also very attractive. We own Bristol Myers, and we own Medtronic. All of those companies are available at not much more than 10 times earnings. Historically, they've sold at more than twice that multiple.
Bill, does that non-diversification hurt you at all, or is that your strength?
Well, I guess it depends on how you think about risk. Our fund has the potential to deviate a lot from the S&P 500, and because of that, we don't suggest it as a one-stop shopping solution for fund shareholders.
So you don't feel tethered then to one or another?
No, not at all. Most of our shareholders are either indexing a core of their portfolio and then they're willing to take more risk with the rest of the portfolio, or they're making a portfolio of different mutual funds. And if you're combining 6 or 10 different mutual funds, you sure don't want each manager picking 200 stocks. You do that and you end up paying active management fees for what's basically an index fund. So we think because the investors are taking on more of the diversification responsibility, we don't have to worry as much about our fund being used as a single fund solution for the average shareholder.
Well, it seems like it might be a commonsensical approach. Was it a hard sell at first?
It was a hard sell originally back in '96 when we started the fund, only because there wasn't a roadmap of successful non-diversified funds. And our point of view was that the industry was changing, the way fund shareholders were using funds was changing, and we found a receptive audience, especially among investment advisors, where they were building up portfolios of funds for their clients.
And Bill, Lori, again, you've got some media names, several of them, in fact, in your fund. A lot of people, I suppose you did say you like things that are out of favor, and boy, that's really putting your words in action there, especially you've got Discovery Communications, Liberty, Viacom, Time Warner. What's your strategy there?
Well, I think there's obviously a lot of concern about how proliferation of devices is changing the way people access their media and especially video. Our belief is that the device proliferation is going to hurt print more than it's going to hurt the good content providers of video. And as we're seeing people, as they commute on a train back and forth to work, they're able to watch video now instead of reading a newspaper or a magazine. We think the demand-driven content providers, channels like Discovery Communication, MTV, Nickelodeon, We think those types of providers are going to earn a fee for their content regardless of what device people choose to watch it on.
And a couple of seconds here, chip makers are also in favor. You like Texas Instruments and Intel also.
Right. A lot of people thought, because we're value managers at the Oakmark Fund, that we wouldn't even know how to buy technology stocks. We didn't own them back in the late 90s when they were popular. Today, we think these are very solid, branded businesses. Their results were hurt a lot in the decline, especially because of inventory reductions. And we think this industry, technology industry, but analog chips more specifically, have a really strong tailwind.
Right. Bill Nygren, partner portfolio manager, Harris Associates, joining us from Chicago.